Welcome to Tech I Spy, and today we're diving right to the very bottom of Penny Tech's stock list. That's not an insult, that's its literal position on the ranking. Crescent NV, a Belgian Internet of Things and wireless technology company, trades at a price so small you'd be forgiven for thinking it was a rounding error. We're talking fractions of a cent in euro terms. On paper, it's a business that builds and connects devices to make cities, buildings, and infrastructure smarter. In reality, it's a microcap minnow navigating a sea where the giants can outspend them 1,000 times over before breakfast. This is one of those companies that slips completely under the radar, not because it's irrelevant, but because it's operating in that strange twilight between potential and peril. There's a lot to be said for examining firms like this. They force us to confront the difference between a good idea and a good investment. Sometimes those two overlap, and sometimes they don't come anywhere close. In this episode, we'll unpack Crescent NV's strengths, its weaknesses, the opportunities it might just scrape into, and the threats that could swallow it whole. You'll hear the story behind the numbers and the context that the share price alone can't tell you. By the end, you might not want to rush out and buy shares, but you'll understand the forces shaping its future, and you'll have another tool in your mental kit for spotting the next speculative roller coaster before you climb aboard. And while you're here, remember to subscribe so you don't miss the next deep dive. Our back catalog is growing every week. And if you want to go even deeper into tech sector investing, check out our series of books exclusive to Amazon Kindle and Kindle Unlimited. They're written to give you a wider view of the sectors we cover here, and they could help you see where the long-term opportunities really lie. For a company sitting at the penny stock fringe of the market, Crescent does have a few cards worth noting. The first is its niche. It's not chasing every trend in tech. It's planted itself in the Internet of Things space, specifically around connected lighting, smart building systems, and wireless infrastructure. That might not sound exciting next to AI or space travel, but it's a part of the digital backbone that cities and industries increasingly rely on. When the lights in a building can tell you how much power they've used, adjust themselves to save more, and feed that data into an efficiency dashboard, someone had to build the hardware and the network to make it happen. Crescent is one of those someones. The second quiet strength is that they are not a new name on the block. They've been operating in various forms since 2018 and have kept their team lean around 40 to 50 staff. That small headcount means they can shift their focus more quickly than a giant that needs to get sign-off from 10 committees before moving an engineer to a new project. For a technology company in a fast-changing market, that agility is worth something. They also operate from Belgium, which puts them at the heart of the EU regulatory and business landscape. That location is a double-edged sword. But the positive side is access to EU-wide funding calls, smart city pilot projects, and the kind of industry partnerships that can land you in proof-of-concept trials across multiple countries without having to open new regional offices. And there's one more point, penny stock or not. They're public. That means they're under the transparency rules of Euronext Brussels, which is not the Wild West of over-the-counter markets. Even at this small scale, they're forced to keep their books and report, and that's more than can be said for plenty of private IoT startups who live off venture capital and keep their cards close to their chest. The most obvious weakness is the balance sheet. Year after year, they've been booking losses, and not just small ones for a company this size. Revenue sits in the low double-digit millions, but net losses can wipe out a quarter of that in one go. For a microcap, that means they are constantly in danger of needing fresh funding just to keep the lights on, which for shareholders usually translates into dilution. At a sub-cent share price, that's a bitter pill. Another weakness is market reach. Yes, they have a position in the IoT space, but they're operating in an environment where the competition is huge and global. The likes of Cisco, Signify, and 100 well-funded regional players can produce similar products, often with better margins thanks to scale. Crescent's small size makes it hard to win contracts outside of niche applications. And in tech, niche isn't always a safe place to hide. It's often where you get quietly bypassed when a larger solution bundles your product category into theirs. Their thin staffing, which is a strength for agility, is also a weakness when it comes to R&D and business development. You can only chase so many opportunities with a handful of engineers and salespeople. That limits how many products can be updated, how many client relationships can be maintained, and how quickly they can respond to competitive moves. And finally, liquidity. This stock doesn't just trade cheaply, it trades lightly. On a given day, you can see price swings of several % on low volume, and that's a signal that even if you wanted to buy or sell in size, you might end up moving the price yourself. For an investor, that's a red flag for volatility, and a warning that you could be stuck holding longer than you planned simply because there's no one on the other side of the trade. The most obvious path is in the growth of the smart infrastructure market. Cities across Europe are being pushed to become more energy efficient, and smart lighting is one of the quickest, most visible wins. It's politically attractive because it saves money on energy bills, ticks sustainability boxes, and can be rolled out within a mayor's term in office. Crescent already has the product base for connected lighting and building automation, which means they can pitch themselves as a ready-to-deploy partner in municipal and commercial projects. Another angle is the European Union's funding culture. Brussels regularly funnels grants, subsidies, and low-interest loans into digital transformation and climate tech projects. Crescent, by virtue of being in Belgium, is geographically and politically positioned to apply for these with less friction than an overseas competitor. That can translate into non-dilutive funding, something they badly need to balance out the risks of equity raises. The Internet of Things as a broader industry is still on an upward curve, especially in industrial settings. Predictive maintenance, real-time monitoring, and automated energy management are moving from nice-to-have to must-have in manufacturing, logistics, and utilities. If Crescent can align themselves with a larger integrator or supply chain partner, they could ride that wave into long-term contracts that offer recurring revenue rather than one-off hardware sales. Finally, there's the penny stock paradox. Sometimes just being a tiny, volatile company can be an opportunity. In the right market mood, with a burst of good news or a flashy contract announcement, the percentage moves can be huge simply because of the low base price. It's risky, and it's not a business model in itself. But it's the kind of thing speculative traders look for, and sometimes that liquidity injection gives a company breathing room to take the next real step forward. The first is the brutal reality of competition. IoT is not a protected niche, it's a crowded battlefield with multinational tech giants on one end and nimble, better-funded startups on the other. A big player can simply bundle Crescent's kind of functionality into a larger smart city or industrial automation package and crush them on price, service, and brand recognition. That's not just theoretical, it's been the death of many small hardware-focused tech firms over the last decade. The second is financial fragility. When you're trading at a fraction of a cent, every fundraising event becomes a survival test. Issuing more shares risks crushing existing investors through dilution, while taking on debt is dangerous without predictable cash flow. A single bad year or even a slow quarter in a thinly staffed business can snowball into a crisis. Then there's the risk of technological obsolescence. In fast-moving sectors, your product can be cutting-edge today and irrelevant tomorrow. If Crescent's current solutions don't evolve with new connectivity standards, cybersecurity requirements, or regulatory changes, they could lose bids not because the product fails, but because it's out of spec. And with limited R&D bandwidth, catching up isn't easy. Finally, there's the market perception problem. Once a company becomes known as a perennial penny stock, it's hard to shake off that stigma. It can deter institutional investors entirely, limit partnerships, and reduce the company's negotiating power. Even good news can be met with skepticism, which means they have to work twice as hard to change the story, and that takes time and resources they may not have. And that's Crescent NV, a tiny Belgian IoT company sitting at the far end of the tech stock spectrum, where the risks are sharp and the rewards, if they ever come, are likely to be sudden and volatile. We've seen the flashes of strength, a focused product line, a strategic location in the EU, and the kind of agility that only a small team can manage. But we've also had to acknowledge the weaknesses, thin resources, a competitive market that can bulldoze smaller players, and a financial position that leaves very little margin for error. The opportunities are there if they can tap into smart city rollouts, EU funding streams, and industrial IoT demand. But the threats are constant. One misstep, one technological shift, or one quarter without new contracts could hit hard. For investors, this is not a set-and-forget stock. It's a case study in the high-wire act of speculative tech investing, where you need to know exactly why you're buying, exactly when you'll sell, and what you'll do if the market turns against you overnight. If nothing else, Crescent NV is a reminder that the bottom of a stock list is not always a place of doom sometimes. It's where you find the most unfiltered examples of risk, reward, and reality in the market. Whether that makes it an investment or just an interesting story is up to you. Thanks for listening to Tech I Spy. If you enjoyed this dive into the less traveled corners of the tech sector, make sure you subscribe so you catch our next breakdown. And if you want to go deeper into how to analyze companies like this, check out our series of books on Amazon Kindle and Kindle Unlimited. They're packed with the kind of sector context and investment thinking that can help you navigate both the giants and the minnows of tech. See you in the next episode.